early October, your world changed. Can you tell me what it's like now, what's changed for you as a governor overseeing a wartime economy?
First of all, when the war started, the first thing we focused on was financial stability. And indeed, we put up a $30 billion selling of reserves, a $15 billion of swap, making sure the markets function. We all know what happens when market starts being in a negative dynamics. And indeed, we achieved that. The markets settled down after the shekel did depreciate, but there was enough confidence. There was some stabilization vis-a-vis the north, and the shekel actually went from 386 all the way down to 3.6. It's now at 3.79, but other markets function as well. We were primarily focused on that, and that's why we didn't touch the interest rates, and we made that message very clear. We lowered interest rate in our last meetings because we felt the markets have stabilized, and we saw inflation decelerating. Indeed, we just saw the CPI. Our target is between 1% and 3%, and it just happened to land on 3%. And so we lowered the rate. It's still restrictive, but we think that was necessary and needed given where we were, given a war, given all the financing. But going forward, as the committee said, it's going to be very cautious, very moderate, depending on how further inflation decelerate and how economic activity and the whole uncertainty around the world develops.
This is obviously a shock across several dimensions, but just to sit on inflation just for a little bit, you talked about the FX channel there. I'm with you. I think we all were. In the immediate aftermath, we're thinking about whether this would develop into an inflationary shock for the economy. What are your thoughts now on the trajectory for inflation? What's the outlook look like?
I think initially we saw the negative demand shock outweigh the negative supply shock, which is primarily in the construction industry, where about a third of the industry is from the West Bank and they're not in. That could affect inflation down the road in a half a year from now, where prices might come back up, and then rentals, some in agriculture. But overall, the negative demand shock overweight, and indeed it put inflation into the target faster than we initially anticipated. Prior to the war, we were on a path of a super softish landing. We were growing at 3.4% in 23. Probably slightly above 3 in 24, and inflation was going to come down into the target anyway. Now we anticipate a 2% growth in 23 and 24. If everything is according to our scenario, which is basically military, primarily focused in the south, intensities will go down somewhere around the first quarter. In that scenario, it's that 2%, and then resuming back to Israel, potential growth of around 4-5% in 25. That's in terms of growth. The big challenge is the fiscal side. The fiscal, the war is costing us directly, and this is give or take about 10% of GDP and another 2% in sort of lost revenue. I call that the temporary hump of the war. The real, and we can. Growth will take care of that in terms of what it will do to debt to GDP. The other side is the permanent component increase in spending on military, in the more expensive debt, and the revitalization of the South. That's about another 1%, and we were able to compress it, at least for now, for 1%. And what I want to point out is this week there was a new national budget, and the government went through, in a pretty short time, through making significant steps to offset that 1% increase. And that puts us probably on a trajectory of stabilizing debt to GDP at around 66-67% in the next coming years.
We talked to a lot of officials, the Federal Reserve, ECB, and they talk about economic projections, and we talk about the varying degrees of angst around trying to hike rates into a recession if you see inflation picking up, or cutting rates at a time where inflation's not coming down. You have a uniquely difficult situation. How much certainty do you have around economic projections that are made at a time where there's still hundreds of thousands of people serving and are not able to fill their jobs, where you have tourists who are not coming to Israel and we don't know when they're going to come back? All of these types of existential questions hanging over that outlook.
So the scenario that I outlay and the numbers that I've given are obviously around an analysis and of a model, and these models have usually large uncertainty around them. Now expand that by a mile, and of course, if there is a north border event, that that means the numbers are very, very different. But you have to basically analyze. We know what's going on in terms of the different segments of the market. We saw actually huge recovery towards November. For example, credit card usage dropped to about 70% when the war started. It's over 100% right now. We saw once missile stops and many families were in the house and the education system was not on. That meant many people were not working. That has come back.
I am wondering, when you look at all the cross-country flows, how much flows from other Middle Eastern countries have resumed at a time when there's a real fear of a widening out in the war? Is there still the same kind of international commerce that can feed the economy in a supportive way?
So I would say, first of all, as you know, the high-tech sector in Israel is very, very important for our economy. The companies obviously are still working. You said obviously there are some workers that are in reserve, but generally they're working. I think the big issue is going forward, not to lose a cohort of new young seeds, the ones that are well known and have revenues will continue to do that. And, hopefully the new relationships that we're just beginning to establish, whether it's with the UAE, et cetera, those will continue. And, the challenge will be to bring a day after in which there is a mechanism, there is security to Israel, security to people in Gaza, that actually, and some prosperity there. And, that is obviously a challenge. It's not really in my hands. But I think if you look at Israel's, talent, it's there in terms of the high tech. There's a lot of demand for, home security economics now. And so I'm pretty confident those things that we're monitoring will be there. Obviously, this is a big shock, and we are continuously monitoring all these developments, as you say, segment by segments, and all this analysis is predicated on the best information we have right now.
It is a big shock, and you're a wartime central banker. How are you planning for the impact or potentially your response if this was to expand, either to the northern border or potentially even more skirmishes outside the Red Sea and et cetera?
So as I mentioned, we first took our main course of action was to make sure there's financial stability. Once that settled down, we went back to the interest rate tool, and even there I said it's going to be moderate, it's going to be cautious, it's going to be partly a function of inflation, economic activity, and further developments even on the fiscal side, and of course on the geopolitical side. If things develop, we will need to readjust our assessment and maybe go back into a mode of, focusing more on the financial stability.
Do you feel like you're constrained to some extent if this war did spread and it increased the shock to the Israeli economy? Do you feel like you are constrained to your ability to reduce interest rates from here?
I think either way, the process would have probably been a slow process.
Yep.
I don't think interest rate, not just in Israel, I think around the globe, when this cycle is over, they will be in a higher zone than they were before. So the path here is not going to be at a rate of hikes that we did upward. It's going to be slow. It's going to be moderate. It's probably going to stabilize at a higher real interest rates, and which means also somewhat higher nominal interest rates. So I don't think we are constrained, except the fact that we are going to be cautious anyway, and we are going to be on the lookout for any financial issues and developments that we look. And as I mentioned, we were We don't often mention fiscal policy in our forward guidance, but we did. And as I mentioned, I think there were significant steps at least to offset the permanent component, which means our debt to GDP should stabilize and not diverge. And I view that as a very important statement to the market.